If you took a standard piece of paper and folded it in half 50 times, how thick do you think it would get? Our intuition usually processes things in straight lines, so most people guess it might end up a few inches thick. But because the thickness doubles with every single fold, the height increases with massive compounding speed. By the 50th fold, that paper wouldn't just be tall, it would stretch 95 million miles into space, reaching all the way to the sun. The human brain simply isn't wired to visualize this kind of exponential math. This difficulty is the exact reason most people fail to understand how wealth is actually built over a lifetime. Those same mechanics drive the growth of compound interest. In a landscape as expensive as 2026, putting that doubling effect to work is the most reliable way to build a massive nest egg. Think of compound interest as a snowball effect. You earn money on your original investment, and then you earn even more money on those new earnings in a continuous cycle. To figure out how fast that snowball is growing, you can use a mental cheat code called the Rule of 72. It reveals exactly how many years it takes for your money to double. This diagram shows the math. You divide the number 72 by your expected annual interest rate. If you expect an 8% return, you divide 72 by 8. The answer is 9. That means your entire investment doubles every 9 years. Using the Rule of 72 changes your perspective. You move away from just working for every dollar and start calculating how fast your dollars can multiply themselves. To see this in action, let's look at Sarah. She starts at age 22, investing $250 a month. She does this for only 10 years and then stops contributing entirely at age 32. Then there is Matt. He waits until he is 32 to start, but he invests that same $250 every single month for 30 years until he retires. This chart plots initial investment against compound interest. Though Matt contributed longer, Sarah retires with a larger nest egg. Her 10-year head start allowed her money to compound sooner, riding this exponential curve much higher. Ultimately, interest does the work. It's a powerful lesson. Time in the market will always beat timing the market. Starting today is the single biggest advantage you have. When you're ready to start, you face a choice. Do you pay a professional to pick specific stocks for you, trying to find the needle in the haystack? Or do you buy an index fund, which simply lets you own the entire haystack? This visual compares the market index to professional managers over 15 years. According to SPIVA data, which stands for S&P Indices versus Active, roughly 90% of professional fund managers fail to beat a basic market index over the long run. Despite that underperformance, many advisors and mutual funds still charge a standard 1% fee for their services. That 1% seems small, but it is actually an invisible thief. It represents the dark side of exponential math. Fees compound negatively against you over time. This chart shows the staggering impact. Over a 40-year career, a 1% annual fee can devour 25% of your total wealth. That could easily cost you $1.5 million. Keeping your investments simple with low-cost index funds is the mathematically proven way to protect your compounding wealth. Let's recap the 3 core rules. Start early, buy the whole haystack with index funds, and avoid high fees. Your first action step is to check your current investment accounts for the expense ratio. An expense ratio is the annual fee you pay the fund provider to manage your money. If that number is near 1%, you're losing a massive portion of your future wealth. Next, automate a transfer of just $50 a month into a broad index fund. If automated, the math works in the background without you having to think about it. For more strategies like this, subscribe to our YouTube channel and follow the Wealth Echoes podcast. You can also check the description for links to our academy. This content is for educational purposes only and is not personalized financial advice. Always perform your own independent research before investing. Building $1 million nest egg doesn't require financial genius. It just requires the discipline to start small today and let the math of compounding do the rest.